All right, let's dive into the work of a trading legend, Jim Dalton. We're going to try to figure out what the market is really telling us, once you strip away all the noise from the news. We're going to look at a framework that can give you a completely different and way clearer view of how markets behave.
You know that feeling, right? You're looking at a chart, you've read all the news, and you think you've got it figured out. And then the market does the exact opposite of what you expected. Yeah, it's super frustrating. But trust me, you are not alone. In fact, that exact problem is what started Jim Dalton on this whole journey years and years ago. So, what's at the core of this whole thing? Well, it's this weird disconnect, right? We're all told to watch the same stuff, company earnings, big economic reports, the major news headlines. But so often, what the market actually does just doesn't seem to match up with any of it.
And check this out. This quote from Dalton himself just nails it. He's talking about his own experience, seeing this stuff firsthand. You'd have a company put out a fantastic earnings report, and what happens? The stock price tanks. It's that kind of thing that led him to a really critical realization. Whatever this fundamental information was, it just wasn't the whole picture. Something else, something bigger was going on.
So what was that missing piece? Well, it meant a complete shift in thinking, a whole new way of looking at things. It meant you had to stop seeing the market through the lens of news and headlines, and instead see it for what it really is, just a giant, continuous two-way auction. And honestly, that one change in perspective, it's the key to everything that follows.
And that brings us to this really core idea he calls market-generated information. The concept is simple but powerful. Stop listening to all the outside opinions and the so-called experts, and start listening to the market itself. The price action, the volume, how much time is spent at a certain price, that is the only pure, objective information you can get. It's the market telling you its own story.
Okay, the easiest way to get this is to think about, say, an art auction, right? The auctioneer starts with a price. If it's crickets, nobody's bidding, they lower the price. But if a bunch of hands go up, the price shoots higher. And this back and forth, this bidding process, it eventually finds a range, a sweet spot, where most people think, yeah, that's a fair price. But what happens if the price gets ridiculously high? The bidding just stops, it shuts off. And if it's way too low, nobody wants to sell. The financial markets, they work the exact same way, 24/7. They're constantly advertising prices, trying to discover what fair value is.
Okay, so that's the theory. But how do you actually see this auction story happening in real time? Well, for that, Dalton uses a pretty specific tool that was actually developed for the Chicago Board of Trade. It's called the market profile. And it's basically a powerful way to take all that market data and organize it visually. Now, listen, this is super, super important. The market profile is not a trading system. It's not going to spit out buy here or sell there signals. You really have to think of it more like an X-ray or an MRI for the market. It's an observational tool. It just organizes all that auction data graphically so you can literally watch the market structure being built moment by moment. So what's it made of? The basic building blocks are these things called TPOs. That stands for time, price, opportunity. The easiest way to think about it is that each TPO, which you'll usually see as a letter on the chart, is like a single footprint. It's proof that at a specific time, the market traded at a specific price. An opportunity for a trade to happen was created right there. And as the day goes on, all these little TPO footprints start to stack up next to each other. Now, in the areas where the market spends a ton of time, the profile gets really wide. Where it doesn't spend much time, it's thin. By the end of the day, what you're usually left with is a distribution, a shape that kind of looks like a bell curve lying on its side. And that shape is a visual map of the entire day's auction. Okay, now within that bell curve, there's one part that's more important than anything else. It's called the value area. This is the heart of it all. It's the fat part of the curve, the range of prices where the vast majority of trading took place. You can think of it as the zone of agreement, where buyers and sellers came together and basically decided, yep, this is a fair price for today. And there's actually a number tied to this. Value area typically contains about 70% of that session's trading. Now, that's not just some random number they picked. Statistically speaking, it represents one standard deviation from the average. But forget the math for a second. What it really means is that this is the zone of highest acceptance. It's where the market was most comfortable doing business. Okay, so by looking at the shape of that value area and where it forms from one day to the next,
we can start to figure out which of two basic states the market is in. And honestly, this is where the real magic, the real insight starts to happen.
So the first state is balance. This is when you get that nice, symmetrical, classic bell curve shape. It tells you the market is just kind of chopping around inside an area that everyone has already accepted as fair value. You know, what most people would call a sideways or range-bound market. Price just keeps coming back to the middle. But then you have imbalance. This looks totally different. The profile gets all stretched out, long and thin. This happens when the market is actively rejecting an old value area and aggressively searching for a new one somewhere else. This is what a trending market looks like. Value itself is literally on the move. And just being able to tell the difference between these two states, it's an absolute game changer for how you approach the market.
Look, understanding these structures and seeing the market this way is incredibly powerful. But Jim Dalton is very, very clear on this next point. The real key, the thing that makes it all work, is mastering your own psychology, the mental game. And this quote, this one really gets to the core of his entire philosophy. He says, your greatest adversary isn't the market, it's you. It's our own emotions, right? It's the fear, the greed, that feeling of FOMO that makes you want to chase a price. That stuff can completely wreck even the most brilliant analysis. This whole framework is really designed to help you fight that.
So what's the end goal here? It's to stop making emotional, reactive decisions and instead use this objective market structure to guide you. So when you see a big, sharp price move, instead of panicking or jumping in, you can take a step back and ask better questions. You can ask, okay, is the market actually accepting this new price? Or is value really shifting? Or is this just a quick move to test the edges of the current range? See? It totally reframes how you think about what's happening. Which, of course, brings us to the big question. Look, what we've talked about here is really just scratching the surface. This is a deep, nuanced way of looking at the market. So how do you go from this little introduction to actually building a real, practical understanding of it all? Well, the honest answer is you have to go straight to the source. We've really just given you the 30,000-foot view today. But the complete, detailed methodology is laid out in Jim Dalton's two foundational books, Markets and Profile and Mind Over Markets. Seriously, if this has sparked your interest at all, those books are where you'll find the full context, the nitty-gritty details you need to really grasp and apply these ideas. To make it easy for you, we've dropped links to both of those essential resources right down in the description below.